Good morning. I'm David Reese, Chair of the New York City Rent Guidelines Board, and I'd like to welcome you to this virtual meeting of the board. This is the second meeting in a series of public meetings and hearings to determine renewal lease adjustments for rent-stabilized housing units in New York City with leases commencing on or being renewed on or after October 1st, 2020, and on or before September 30th, 2021. Before I get started, I would just like to reiterate something I had said last week, which I'm very grateful to the staff, which has been very nimble in responding to the impact of the pandemic on the operations of the board in terms of the research they're doing and adapting to this virtual environment. I will now take roll call. Please respond if present. Christina DeRose.
Present.
Shayla Garcia.
Present.
Cristian Gonzalez Rivera.
Present.
Leah Goodrich. Oh, Leah, I
Present.
think
Present.
there we go.
Sorry.
Great. Thank you. Cecilia Hossa.
Present.
Alex Schwartz.
Present.
Patty Stone.
Present.
Scott Walsh.
Present.
David Reese present. Our next virtual meeting will be May 5th, starting at 9:30 a.m. The board will hear testimony from speakers who have been invited by the tenant and owner members of the board. Speakers representing owners will be heard from 9:30 a.m. to noon, and from speakers representing tenants from 1 p.m. to 3:30 p.m. Information on how to attend this meeting is posted on our website, nyc.gov/RGB, in our meetings. If you are interested in receiving email updates about upcoming RGB meetings and hearings, please go to our homepage and click on RGB email updates under quick links. The preliminary vote for rent-stabilized renewal lease adjustments is currently scheduled for May 7th. This will be a virtual meeting. Information to attend this meeting will be made available in the near future. Today, staff will present the 2020 Income and Affordability Study and the 2020 Mortgage Survey Report. Both of these reports have been posted on our website and are available to the public, as well as the slides from the staff presentations. Just click research on our homepage to download these documents. Before we proceed with our reports, I'd like to take a moment to explain when the new lease adjustments determined by this board over the next few months will go into effect. The current adjustments of 1.5% for a one-year lease renewal and 2.5% for two-year lease renewals are in effect until September 30th. So any lease renewed from now to that September 30th date are subject to these current guidelines. The new adjustments set by this board will go into effect on October 1st and will affect rent-stabilized leases renewed from October 1st, 2020 through September 30th, 2021. With that, I'd like to turn it over to Andrew. Andrew, you're muted.
Before I go into the little bit of presentation I was going to do, I just want to go to the share my screen and just show you the quick links to our emails and just where you can download our reports for the people who are watching. So I'm just going to do that quickly. So this is our homepage for quick links. If you want to be added to our email updates, which will give you information about our meetings, when they are, how to join them, and also our reports, you would just click on here, which gives you the email updates page, and click on this link to subscribe to our updates. And then you'll go to the nyc.gov email updates page. Just put in your email, create a password, put in your zip code, and then down below here, just click on New York City Rent Guidelines Board. So you'll get all our meeting announcements. So that's how that works. And if you're interested in our research, again, from our homepage or any one of our pages, you can click on research up here, and you'll see our current reports that have been released, including the two that we're talking about today, as well as our presentations. So if you want to follow along at home, if you're an attendee on a phone, and you do happen to be by a computer and you want to follow along with the slides, you're welcome to do so. So that's a little bit of an update there. So now I'm just going to go over a little bit. We wanted to make sure that we're responding to some of the issues you had, they brought up last week in terms of the data that we're presenting. So just to go over a little bit about what we sent you, just briefly, but since this meeting has a lot to do with the Income and Affordability Study, which is our local economy, we sent some links that I hope you had a chance to review. We had sent an initial analysis of housing costs of households most vulnerable to job layoffs, which was conducted by the NYU Furman Center. A summary of the Coronavirus Aid, Relief, and Economic Security Act, the CARES Protections Act, which has elements for tenants and owners that are federally supported rental buildings. And that was released by the Urban Institute. And a report from the New School Center of New York City Affairs entitled The New Strain of Inequality, the Economic Impact of COVID-19 in New York City. So these have to do, with the economy in the city and somewhat nationally as well. We had also sent you some links to the Federal Reserve Bank of New York and their website. In particular, we wanted to point out the weekly economic index. And this is real economic activity using timely and relevant high-frequency data, which is posted on the Federal Reserve Bank of New York website. It is done by a couple of economists that work for the Fed, as well as a Harvard economist as well, but it is something that is posted on the Federal Reserve Bank website. And it represents the common component of 10 different daily and weekly series covering consumer behavior, the labor market, and production. So it's a weekly look at what's going on with the economy. So it's just interesting to note that the WE is currently at a negative 11.59%. And for the week ending April 25th was at, that was for the week ending April 25th, and April 18th, it was a negative 11.8. Just to put it in some context, at the end of February, it was 1.58%. And I know that may sound a little bizarre, and I think this graph probably illustrates it better than what I just said, but here's the weekly, the WE from 2008 going to present. And I think it's a good reflection of probably what we all feel and what we think is happening with the economy from everything we've heard. So this is interesting that the WE followed, and here's the recession that we had in this time period where it dropped here and there was negative growth in GDP. And as you go along, we can see we're humming along, and then we sort of fall off a cliff with the current COVID-19 crisis. So I just wanted to put this in perspective, how the economy is what we think is happening. And I think this is just an illustration of somebody is measuring this as we go along. And it will impact, both sides of the equation, I believe, owners and tenants, but it just sort of gives everyone a visual of what's going on. So I just wanted to point those few things out. Now, Danielle is going to go specifically more into the economy and what's happening currently with New York City and New York State, and somewhat of national numbers as well. But we just wanted, we felt there was something that would sort of give you a visual of what truly is going on. So what I'm going to do is back out of this and let Danielle take over here with the Income and Affordability Study.
Hey, good morning. Okay, everyone's seeing my presentation, right?
Danielle, it's not in presentation mode. It's in a different mode.
It is. Hold on.
It includes your personal notes, I think.
Okay, I practiced this before, but let me try again. Okay, let me try this one more time. I swear I practiced this.
So it's yeah.
There we go.
There we go.
But are you seeing my notes?
Nope.
Okay, good. Okay. Hey, good morning. I would like to start by reading a special note regarding the 2020 Income and Affordability Study. While published in April of 2020, this report focuses on data from 2019. Due to the as yet unknown impact of the COVID-19 virus, it does not reflect the current economic condition of New York City and should not be interpreted as such. A supplement at the beginning of the written report provides some of the limited current data that is available from government bodies and also follows later in this presentation. Any data from this report that can be updated before the final vote of the 2021 rent guidelines will be distributed via a memo before the vote. Future editions of this report will better reflect some of the hardships that our fellow New Yorkers are experiencing. Just to explain a little bit about the INA study, it is researched and presented each year in accordance with Section 26-510B of the Rent Stabilization Law, which requires the Rent Guidelines Board to consider relevant data from the current and projected cost of living indices and permits consideration of other measures of housing affordability in its deliberations. To assist the board in meeting this obligation, RGB research staff produce an annual income and affordability study, which reports on housing affordability and tenant income in New York City's rental market. This study highlights year-to-year changes in many of the major economic factors affecting New York City's tenant population and takes into consideration a broad range of market forces, rent levels, and public policies affecting housing affordability. Such factors include New York City's overall economic condition, including unemployment rates and inflation rates, as well as household income and housing costs, and other relevant factors such as the number of eviction proceedings and homelessness levels. I will now briefly summarize the highlights of the 2020 Income and Affordability Study's 2019 data. In summary, 2019 saw New York City with growth in gross city product, with an inflation-adjusted or real terms increased by 2.4% during calendar year 2019, the 10th consecutive year of increase. The city also gained 95,600 jobs, a 2.1% increase. And sorry, got off pace. And inflation rose at a slightly lower rate than the previous year, with prices rising 1.7% on average during 2019 in the metro area. And inflation-adjusted wages increased by 0.4% in real terms over the prior 12 months. The unemployment rate fell to 3.9%. In housing court, non-payment cases fell 24.3% in 2019, and calendared cases fell by 22.2%. Evictions also fell by 15.1% during 2019, and homeless staying in city shelters decreased, falling by 0.9%. While the number of cash assistance recipients decreased by 6.0%, and the number of food stamp recipients, now known as SNAP, decreased by 5.0%. I will now focus on some of the data from the supplement to the report, which was in the beginning of the report and is the most recent data that we have. The Federal Reserve recently published their summary of commentary on current economic conditions by Federal Reserve District. Commonly known as the Beige Book, this report is published 8 times per year. Each Federal Reserve Bank gathers anecdotal information on current economic conditions in its district through reports from bank and branch directors and interviews with key business contacts, economists, market experts, and other sources. The most recent Beige Book was published on April 15th, 2020, and is based on information collected on or before April 6, 2020. Excerpts from the opening summary of their assessment of the economy follows, and more details can be found in the supplement to the report. Per the Federal Reserve Bank of New York, the second district economy deteriorated sharply in the latest reporting period amidst widespread shutdowns related to the coronavirus pandemic. The job market weakened substantially and wages were flat to lower. Home sales and rentals, commercial leasing, and construction activity have all largely stopped. Finally, financial sector contacts noted deteriorating conditions, and banks reported widespread weakening in loan demand, tighter credit standards, and higher delinquency rates, but have been more lenient on existing loans. One of the best measures of employment and other labor force statistics is the unemployment rate. This rate is based in part on a survey that is conducted monthly by the U.S. Bureau of Labor Statistics and is called the Local Area Unemployment Statistics Program. Unfortunately, there is a lag time of approximately 3 weeks after the end of each month in reporting of the data. Per the last full month of data preceding the COVID-19 crisis, the New York City labor market was 4.08 million persons. In the absence of current labor force data, we will focus on initial unemployment claims for a 6-week period from March 8th through April 18th, 2020, the most recent data available for analysis. Note that because of technical difficulties with the New York State unemployment application system, these figures may not be a complete tally of the number of people who lost employment during this 6-week period. While the number of initial claims for unemployment insurance is an imperfect proxy for the unemployment rate, it is the most recent data currently available in regards to the labor force. Over this 6-week period, 624,277 initial claims were filed by New York City residents, compared to approximately 31,328 in the same period of 2019. This is an increase of almost 593,000 claims, or 1,893%. By borough, the Bronx had approximately 99,807 claims, or an increase of 1,472%. Brooklyn had approximately 184,683 claims, or an increase of 1,819%. Manhattan had approximately 96,916 claims, or an increase of 1,334%. Queens had approximately 210,647 claims, or an increase of 2,774%. And Staten Island had approximately 32,225 claims, or an increase of 2,285%. These figures compare to increases in initial claims in New York State of 1,737%. That's 1.4 million claims in total. And the US had an increase of 2,000% in claims, with a total of 24.6 million claims. The New York State Department of Labor also reports on the industries most affected as based on initial unemployment claims. This data is not available at the citywide level. For reference, the New York State labor force was 9.6 million persons in February of 2020, of which New York City makes up 43%. Per their information, for the 6 weeks studied in the supplement, the industry with the largest net change in employment was accommodation and food services, which saw an increase in initial unemployment claims of 272,418, or 3,233%. The average salary in this industry in New York City in the most recent time period available for analysis, the fourth quarter of 2018 through the third quarter of 2019, is $38,122. Retail trade also saw a large increase in initial unemployment claims, with an increase of 185,569 claims in 6 weeks, or a 2,825% increase. The average salary in this industry in New York City is $45,848. The third highest change in initial claims was in the healthcare and social assistance sector, which rose by 148,797 claims, or 2,261%. The average salary in this industry in New York City is $51,705. The construction and utility sector saw an increase in initial claims of 117,914 during this period, or an increase of 887%. The average salary in this industry in New York City is $87,543 a year. The only other industry to see a rise of more than 100,000 claims was in the administrative and support services sector, which saw an increase in initial claims of 111,254, or 1,072%. The average salary in this industry in New York City is $67,737. It is not possible at this time to ascertain if the change in New York City in these industries would be at the same proportion as New York State as a whole. Prior to April of 2020, the maximum New York State unemployment compensation was $504 per week, or $2,184 per month, For those making $52,416 per year or $4,368 per month or more. The typical compensation for those making below $52,416 is half of the salary the claimant was earning before becoming unemployed. New York State unemployment is capped at 26 weeks of compensation. In the wake of the COVID-19 crisis, New York State unemployment insurance both expanded eligibility and increased compensation for the period of at least April 4th, 2020 to July 31st, 2020. The new guidelines allow for some of those who are not typically eligible for unemployment insurance, such as the self-employed, among other categories, to receive compensation. Individuals who would not normally qualify for New York State unemployment insurance will be covered at the same rates as those who do through the Federal Pandemic Unemployment Assistance Program. In addition, all recipients of either Pandemic Unemployment Assistance or New York State unemployment insurance will receive an additional $600 per week through the Federal Pandemic Unemployment Compensation Program. At the maximum compensation for those making $52,416 a year or more, which is $4,368 or more per month, they will now receive $1,104 per week or $4,784 per month. And just as an example, for those making $40,000 a year, which is $3,333 per month, they will now receive $984 per week or $4,264 per month. For those making $30,000 a year, which is $2,500 per month, they will now receive $888 per week or $3,848 per month. For those making $20,000 a year, which is $1,667 per month, they will now receive $792 per week or $3,432 per month. The Pandemic Unemployment Assistance Program also provides for an extra 13 weeks of compensation for a total of 39 weeks. This graph illustrates the hypothetical monthly income received by 3 sample households. A household with 1 minimum wage worker making $31,200 per year, a typical rent stabilized household making $49,000 per year, and a higher income household making $80,000 per year. The graph illustrates the monthly payments that would be received by each of these sample households over time, including while working full-time in February of 2020. And I hope you can see my mouse. And if you're unemployed and receiving New York State unemployment in March of 2020, this is where your income would drop to. If you're unemployed and receiving either New York State unemployment insurance or pandemic unemployment assistance, in addition to the $600 per month pandemic unemployment compensation payments, which is from April to July of 2020, this is where your income, your monthly income would rise to for each of these households. The graph then extends to August of 2020, when pandemic unemployment compensations are currently set to expire and payments will revert to March of 2020 levels. Should the pandemic unemployment compensation be extended by Congress, as noted by these thicker dotted lines, the payments will remain at April 2020 levels. Current guidelines allow for 39 weeks of compensation or payments through December of 2020 for those who were laid off in April. Without changes, for those who continue to be unemployed in January of 2021, income will go down to $0 a month. These 3 dashed baselines show the amount of monthly income each of the sample households was making while working full-time. As the graph illustrates, both the minimum wage household and the typical rent stabilized household receive half of their income from New York State unemployment insurance in March of 2020, while the higher income household receives 1/3 of their former income and only slightly more than the rent stabilized household. In April of 2020, both the minimum wage households and the rent stabilized household would receive more in New York State unemployment and pandemic unemployment compensation payments than they were previously making working full-time, while the higher income household is still at a loss. And as a final reminder, I would like to reiterate a special note regarding the 2020 Income and Affordability Study. While published in April of 2020, this report focuses on data from 2019. Due to the as yet unknown impact of the COVID-19 virus, it does not reflect the current economic condition of New York City and should not be interpreted as such. A supplement at the beginning of the written report provides some of the limited current data that is available from government bodies and was presented here. Any data from this report that can be updated before the final vote of the 2020 to 2021 rent guidelines will be distributed via a memo before the vote. Future editions of this report will better reflect some of the hardships that our fellow New Yorkers are experiencing. Thank you, and I will now take any questions on either the presentation or the report.
Danielle, before you do that, there were a few indicators that came out just last night and this morning, and you had done a new slide for that. If you don't mind just pulling that up.
Sure.
There was some late breaking economic news. If we had a scroller at the bottom of our screen, like CNN or one of the news channels, it would show that. But so there's a few important points I think that were released. And these are GDP in particular is something that we track in our income and affordability study every year. So, and we do quarterly data, I believe. So Danielle, go for it.
Sure, these are numbers that came out just in the last 24 hours. We have first quarter GDP, which was annualized to a rate of negative 4.8%. So that goes from January through March. Then we have the US CPI for March, which was negative 0.4%. That's something we also track in the INA study. Then we have, this is not something we would normally track in the INA study, but just this morning, there was the initial unemployment claims for the week ending of April 25th. So for New York State, for just this week ending April 25th, there was 218,912 initial claims, which is an increase of 6.7% over the prior week. And they estimate that in the week ending April 11th, which was a little over 2 weeks ago, the New York State unemployment rate was 14.4%. We do not have these last two bullet points for New York City, but this is the most recent information available. So now if there's any questions. No questions? Okay.
Can we give comments or is that after?
I think that's totally fine to give comments, to have a discussion about this.
Okay. Well, I just wanted to point out a few things. Thank you very much, Danielle. We all really appreciate the reports. There was one part where it was mentioned that non-payment filings fell, I think by about 24%.
Yes.
I've been an attorney for close to 9 years. And one of the reasons that I can, from my experience as a tenant attorney, is that when the Universal Access to Counsel law passed, there were a lot more tenant attorneys in court. And we saw just on the ground that as a result of that, there was a lot more thinking that went into filing certain cases. But we also saw that other types of harassment in terms of pushing some tenants out were also going on. So I wanted to provide some perspective as to those numbers. And also, I think that it's interesting that it was mentioned on one of the graphs that, a typical rent stabilized household, the income is about $49,000 a year. I put that into a paycheck calculator for New York City, and after taxes are taken out, that is about $1,523 every 2 weeks. And that's not including contributing to any retirement. That's just after taxes are, or any other contributions. That's just after taxes are taken out. And I don't know about you, but when I search for a 1-bedroom apartment, it's pretty hard to find something under 1,900. So all of that to say, my first beginning comment and discussion is how difficult it is even under normal times. But then added to that, if you're not making 49,000 and you're making 0, I think I think right now, like the data, we're, you know, one of the first questions or things that we've put forward is whether we should have a rent freeze. But honestly, I think some of this data reveals that we should be looking at a rent rollback. So that's my first comment. What do you all think? I mean, if you're all in agreement, we can vote now.
Well,
I
let's
think Patty's trying to talk. I unmuted.
yeah, go ahead, Pat.
Oh, sorry. Patty, you're unmuted.
I don't think, hold on, I don't think so.
Yeah, we can hear you.
We can hear you now.
Oh, okay, great. No, I certainly, listen, what's going on now in the world and in New York City is terrible. I'm not saying anything different. And it's, you know, certainly not only the tenants that are suffering, every human being is suffering, every owner is suffering, every tenant is suffering, everyone across the board. I cannot agree to a rent rollback because I don't think that hurting the economy anymore is helpful in any way. As far as people that aren't, that don't have anywhere to live, that's not what this board is about. This board is about deciding increases for people that are already in place, rent stabilized tenants. So I don't think we can make this more of a bigger than what we're supposed to be doing here.
So what I've seen is from the perspective of someone who is an attorney representing the people who are getting evicted, a minor rent increase often results in someone heading to housing court to fight eviction. So we are talking about home, we are talking about eviction because a big part of our job is to determine and to simulate a fair rent market. And some of the factors that we consider are, as you mentioned, landlords, and then some of them are also how it will impact tenants. And we just, you know, heard a lot of data about that. In terms of everyone being affected, everyone is affected, but everyone's being affected differently. How can you really compare, for example, any landlord who has a business, right? A tenant who, if the rents increase, may be evicted in the middle of a pandemic, may enter the homeless shelter. And in fact, if we have stay-at-home orders, or, you know, we are supposed to be quarantining, what effect will it really have if we have an uptick in people who are getting pushed out of their homes? They have to roam the streets, they have to enter the homeless shelters. So it's going to cause a second wave health crisis. So that's another thing that we want to think about.
Well, I understand that, but right now there are no evictions going on, none are permitted. So
For now.
That's correct. For now, we can only deal with what's happening now. I don't know what's going to be 6 months from now, and neither do anybody sitting on this board. We have to deal with the facts as we have them. And as I said, I get what you're saying. I understand, but I am certainly not going to minimize what owners are going through here, because they still have to run their buildings. They still have their costs. They have to pay for their employees, and they have family members that are also, you know, sick and going through exactly what tenants are going through. So it's not only because they're an owner, and not every owner is a big owner. There are plenty of small owners that are really suffering right now through this. So I just
Business
can't.
venture, though.
I'm sorry, what?
So it's a business venture.
It could be, it's their lives. Some of these small owners live in the buildings. It's not just a big, you're always grouping owners as, you know, these, that they own all this property and they're all wealthy, and that's not always the case. I'm certainly not minimizing what the tenants are going through. I'm just saying I cannot agree to a rollback.
Can I interject for just 1 second? I just want to make sure Cecilia is able to speak. Cecilia?
Yes, I'm here.
Okay.
I'm here.
Okay, thank you.
You're welcome.
Yeah, go ahead.
So, okay, so I think it's quite clear that, you know, the COVID crisis has really hit New York City hard. I mean, it's like these numbers really show that, and that's true for both tenants and landlords. I won't say that landlords and tenants, you know, as a group are hit equally as hard, you know, but just that everybody's feeling some sort of pain. I think that's pretty clear. But what's also true, I mean, again, according to the data, is that the people that are feeling the most pain are also the people that have always felt economic pain, the most economic pain. I mean, it's like, which means lower income New Yorkers, many of whom are immigrants, people of color, especially. And, you know, while not all of the usual data that we use for the picture of economic conditions is sort of available and current enough to show what's happening right now, I think the Rent Guidelines Board staff have actually done a great job in pulling out what data does exist. So that's been really important. So you know, it was really interesting to see. I mean, it's like that unemployment insurance claims have been up to 620,000. You've seen people sort of experiencing wage cuts and furloughs. And certainly when you look at, you know, the Furman Center report that you mentioned earlier, you're seeing that a lot of them are sort of concentrated in a lot of those wage cuts, and a lot of those people who have lost their jobs are also the people who are lower income. So we're seeing that, and we're seeing also, this comes from the Federal Reserve, that employment prospects in a lot of service industries, you know, including the very large and significant tourism industries and other service industries, are not looking good. I mean, it's like, so it's not only is there a problem now, but there's likely to be a problem moving forward. But I think that one thing that's especially relevant to us as a board, I mean, it's like something that we have jurisdiction over, is that the data do seem to show that we have reason to believe that rent stabilized tenants are especially hard hit, and will continue to be hard hit. I mean, for instance, if we just look at the demographics of rent stabilized tenants, you know, 42% are Latinx compared to 28% of, you know, private non-regulated tenants. An additional 22% are Black non-Hispanic, compared to a lower percentage in non-stabilized units. Nearly half have a high school degree or less, which again, I mean, it's like decreases their job prospects, makes them more likely to be lower income, less likely to have emergency savings. And in fact, I mean, it's like that I think it was $46,000. The average income of a rent stabilized tenant is fully $20,000 lower than a non-stabilized tenant. And so, of course, I mean, it's like these numbers are based on, you know, sort of older data in terms of these income numbers and these demographic numbers. But what we do know is that, you know, the rent stabilized tenants, I mean, it's like who were hurting before COVID are hurting even more now. And the ones that, and then there are others that were not hurting before COVID who are much more likely to be hurting now. And, you know, as a public member, and of course, I'm saying all this as a public member and sort of at a, you know, of course, I mean, it's like, it's sort of my role, as it is all of our roles as public members, to sort of balance the needs of tenants and landlords. And, you know, that was true for public members even before COVID. But I don't know, I also think that we should use our power to influence outcomes in our particular corner of New York's sort of large and complex economy. You know, we have the ability, what we do have is the ability to make a decision that determines whether rent stabilized tenants will bear a greater burden in these uncertain times. And, you know, at the risk of, you know, at the risk of showing my cards, I mean, it's like, but I guess it's what we're doing here. You know, I think that for at least the next year, I mean, as concerns 1-year leases, that we should not increase the burden on tenants. And I think that the data that we have supports a 0% increase in 1-year leases. We can talk separately about 2-year leases. That's also part of what we need to talk about. And again, this is not to minimize the pain of landlords. I mean, I'm aware, I mean, it's like, as Scott, you said last time, that operating expenses often get shoveled back into debt service. So it's not 100% profit, you know, and of course that debt service is a burden for landlords. But I have to believe, and again, I really want to hear from you, Scott, and Patty especially, but I have to believe that there must be some sort of relief available for landlords, whether that's mortgage forbearance or cash assistance or maintenance of buildings or other kind of relief. And of course, providing that sort of relief for landlords is outside of our jurisdiction as the Rent Guidelines Board. It would be up to, you know, decision makers above our pay grade. But the fact is that, you know, even though the data show that, you know, the median rent stabilized tenant would be made whole in terms of income by the additional unemployment insurance benefits, remember that that income is not income from wages and salaries, that's benefits. So they're already needing to get benefits in order to pay rent. And so I imagine, I mean, it's like there must be some other kind of relief for landlords as well. I mean, it's like in this time, sort of landlords, I mean, it's like seek some kind of relief to be made whole as well. But again, I look forward to, you know, hearing from my colleagues, especially staff, especially Scott and Patty, about what you think the possibility is of landlords receiving some kind of relief, and in the wake of advocating for a 0% increase in 1-year leases.
If I can also add that the unemployment numbers are also, there are people who have been able to access that unemployment. They're the ones who got through, because we know those lines are crashing all the time. And then those are also the ones who qualify for unemployment. There's a lot of people out there who work, who are paid, who for whatever reasons do not qualify for unemployment. And I think we all have to remember that those numbers that we're seeing are a lot higher than the numbers, because there is a lot of the economy in New York City is not sort of the you know, W-2 employee who gets who would qualify for unemployment. I also do have a question that, or better understanding about, I want to better understand, like, if landlords are not able to make their mortgage payments, is there I know a lot of deals, you know, I'm seeing it myself, are being made between landlords and their banks, but it's more of a, it's not a federal program or any sort of program. It's sort of, they've been working with that bank for years, and so they're able to get forbearance or whatnot. But I would like to better understand what sort of mortgage, like what happens if the landlord isn't able to make the mortgage payments. And that's just something I don't know well.
You mean other than the 90-day relief from the government?
Right, so the 90-day, my understanding is that it's a 90-day relief. Well, I guess that is my question. Is it, so the bank, the landlords are also getting a 90-day relief from paying their mortgage payments? Or is it that, and then at day 91, they have to pay all 3 months back, sort of similar to the rent that forbearance that people are getting? Or how, like, I just, honestly, I just don't know enough about it.
It's my understanding that there could be forbearance for mortgage payments, but that would be put on toward the end of the loan again, that you would just extend the time period of the loan.
Right, it's not waived.
It's not waived.
Right.
Right. Now,
But then if it's at the end of the loan, that's at the end of the term, I guess my question is that an automatic thing, or is it something that sort of has to be negotiated on a case by case?
My understanding is that if the landlord has a mortgage that is federally guaranteed, in other words, that it's controlled by Fannie Mae, Freddie Mac, or FHA, there is forbearance as well as a moratorium. But if you don't have a federally supported mortgage, which accounts nationally, I think, for about, I don't know, 60-something% of all rental housing, there right now is no provision. And I think it's important to know what extent the current protections apply in New York. I don't know the answer to that.
The staff will take a look and get back and let you know what exactly is available for New York, owners in New York State and New York City. So we'll take a look into it and we'll get back to you shortly.
For Andrew and Patty, I mean, since Christina isn't probably familiar with liens and how it all plays out, but you don't pay your mortgage, you have a lien put on your property, you go in default, and hopefully it doesn't happen, but a bank can take over your property, which is not good for tenants or owners. So I think if that's the lien process is very unfamiliar to people and just how financing works, we should set up a finance person should fully brief you on that, because if that's uncharted territory, that's a really important missing link. And it's not clean and easy. And the whole process of being defaulted on your loan creates these things don't get resolved in a month. These things take 6 months, a year to resolve. It's not a clean, easy process that some people might like to make you believe, having done loan modifications. I think we should have somebody talk about loan modifications to this group.
Can I say something?
Go ahead, Cecilia.
Hi. So right, I do loan modifications. So basically, like Scott said, this is not something that it gets resolved immediately. There's a process. You have to show hardship. It's not just stating it. You really have to come up with the proof that you are experiencing problems paying the mortgage. Now, there's a forbearance, a 90-day forbearance, yes. For a lot of people who are Freddie Mac and Fannie Mae, their arrears hopefully will be capitalized at the end of the loan. But those that continue to experience hardship, it'll be considered like a one-to-one. I guess the lender will revisit those individuals that continue to experience issues. They can't really reinstate the payment, but those will be for individuals who will continue to have problems paying the mortgage. This is a 90-day. It's a Band-Aid, right? It's a Band-Aid. It's a 90-day that will sort of like ease up the issues right now. And I'm pretty sure that they will continue to see how the economy is going. I'm pretty sure there'll be more relief, right? So for smaller owners, this will be something that they go through on a daily basis. The tenant doesn't pay, can't pay the mortgage, have to find ways how to come up with the money. If I can't come up with the money, then I have to tell my lender, listen, I can't pay. The lender says submit an application. Submit an application. Sorry, guys. Submit an application. And there's a process, right? And then they have to review your financials. So it might, like what it might start with the 1 month, it might take 6 months, it might take almost a year. And like Scott says, a lot of these people cannot pay, and the lender will start a foreclosure proceeding, which is no normal thing. But there's a lot of assistance out there. And depending on what's going on in the market and the economy, I'm pretty sure the government will make more programs available for landlords and also for tenants, right? Because the tenants, I mean, the landlords will go to the lender, okay, submit an application, I can't pay, make a payment plan, whatever. But what about the tenants? The tenants will continue to suffer right? The tenants will have to create a case for them and say, look, I can't pay, I don't have a job, I can't come up with the money. There's got to be a payment plan, right? For the future when I go back to work. And what the future looks like right now, it's really up in the air. We don't know what's going to happen. We don't know, right? So I guess we're all learning as we go, and we're waiting on the numbers. We're waiting on the news, what the mayor is going to say, what the government is going to say. We don't have a destination yet, right? So that's my thing. It's all up in the air. Our destiny, it hasn't been charted yet, right? So we are taking steps one day at a time, according to how it develops. Right? Unfortunately, it is sad what's going on in the country, and and it's not only in the U.S. It's actually, the whole world is suffering. So yeah. But that's just what I wanted to say. We don't know. We look at numbers, we look at data, and the unemployment numbers, and we don't have the real numbers because there's also the paper applications for the people that haven't been able to connect online. So those numbers that we see are not totally reflected. It's not reflecting what it actually is right now.
Morning, all. I think that we're in a really difficult position as the board, but I think as like the country of like what we prioritize, I think that there are a lot of racial inequities that have been existing in this country for a very long time. And I think this is, to Christian's point and other folks' point, it seems like it's, flaring up in a way that we have traditionally not seen it, especially with this pandemic, specifically with the deaths that we're seeing. And I think like as a person that's like seeing things on the ground, and I know many of us are, it's been really difficult. We've seen, in the Bronx where people are making $25,000 a year in the community that I serve on average. Community Board 4, we're seeing blocks devastated with 25 deaths just in one block because people are so densely populated, and we're so afraid of seeking help. And I think we're also missing out on a few numbers, undocumented folks who, don't qualify for any of that support and assistances, as well as the folks who are doubling and tripling up that we don't count as homeless populations who are now even more marginalized than normal. I think that this conversation to me is not only extremely personal because of where I live and where I grew up, is thankfully where I have the privilege of supporting the community members right now, but also, just seeing the devastation. Seeing the devastation of loss of like not only income. People are not necessarily thinking about, how are we going to get back to work? They're thinking about how they bury their family members. They're thinking about where are they going to get the next plate of food in this moment. And I know that landlords and tenants are feeling this as deep as possible. I just want to air us to remember not to commit, like as a board, not to commit the same mistakes that we made in 2008 when we saw that dip, and we still saw continuing rent increases. And I want us to think broader than just 1-year leases and think about 2-year leases, as many and most of the tenants that we work with, and the data shows us this, are signing 2-year leases. And what does that relief look like for them? And folks do that out of stability, right? Even though they have a right to a lease, that doesn't negate the hardship that tenants constantly face living in rent stabilized units. We are, even in the middle of this pandemic, when people are asked to shelter in place, we're working with tenants who have no heat and hot water. We're working with tenants who have, extreme mold and, disinvestment in their buildings for decades. And now, we're seeing that flare up in a different way, in a more needy way, because everyone's stuck at home. And when you have 3 generations in one apartment sharing rooms, there isn't, staying at home isn't as cool as maybe we might expect in other communities as it is in, in a community like the Bronx, or in the as a densely populated city as New York City. And I want us not to lose sight of that as we go into, and we're going to move fairly quickly in this process. We're voting on the plenary vote next week, and it weighs really heavy on me. For us to think about, like, what does this mean long term? And yes, everyone will be hurting, but as we see, even with the relief fund we're seeing from the federal government, and even how the state talks about businesses, we're seeing that those models of businesses are being looked at, but we're not having any conversations about what this means long term for tenants. We're not hearing that from the state. We're not hearing that from the federal government. And I hope that this board takes that really takes on that responsibility, that we see that other people aren't acting and that we have to act. We have no other choice but to act in this moment.
Well, can I respond to that? Obviously, I agree with a lot of what you're saying, but I completely disagree with deciding for a 0 for a 2-year lease. There is no reason for a tenant to have to accept a 2-year lease unless they're planning to get an increase. We don't know what's going to be happening 2 years from now, and the board meets again next year. So why would you ask us to basically punish landlords in advance when the economy was doing great? Unemployment was down, more people had jobs than in years before. And yes, this horrible virus has turned everything upside down for the last 3 months, but we don't know what's going to happen in the future. So it's one thing to ask for immediate help for the 1-year increases, but not to jump to say it should be 0 for 2 years, because that would mean almost every tenant would sign a 2-year lease to make sure that they have 0, even if in 6 months from now, things start getting better, and in a year from now, they're much better, hopefully. So I think that that's an outrageous request, is what I think.
Can I come in? A couple of things. I think I agree a lot with what Sheila just said. This is a catastrophic situation for so many. I wish that our job was to provide rental assistance, because that's really what's needed, but unfortunately it's not. But I do think, we feel very strongly, we cannot exacerbate the problem, which would be, I think, a rent increase. I think I think we should be creative in thinking about 2 years. It may not be necessarily a 0 increase for 2 years, but maybe the first year should be 0, regardless of whether or not it's a 1 or 2 year lease. So we could talk about the second year to provide more stability. But I think that it's imperative, not to exacerbate the problem, which is, increasingly severe, and we don't even know how severe it is right now, given the points that Cecilia made, that the unemployment claims have not all been processed.
The only thing I'd like to respond to that is, I just want to make it clear, tenants have a choice of a 1 or 2 year lease. You cannot make it that tenants can take a 2-year lease and have a 0% the first year and then an increase, because you're not permitted to have escalations during the lease period. So we have to have separate numbers for a 1-year lease and then separate numbers for a 2-year lease. We can't have an escalation in a 2-year lease. I just wanted to be clear on that.
Well, I don't know if that's true. I don't know if Andrew wants to chime in around, like, in the past, the board has voted on segmentations of different types of landlords. There was a port tax back when we actually wanted a version of that for tenants, and then landlords were able to get that, and we sued them for it and they won, and so that's held up in court as well. So we can get a memo or something drafted around what are the different kinds of alternative structures that we can create as the board, and in order to decide what rental adjustments should look like. But I think the only thing I would say is that, we are, when it comes to what tenants are dealing with, or what, common New Yorkers who aren't making $80,000 a year are dealing with, we always have a dual way of looking at it, right? Either things might get better for you, But when we also do the same thing for landlords, we don't actually visualize that the same exact way. And I want to remind us that like we are talking about New York City, an extremely segregated city. We're talking about like we cannot ignore that there are racial dynamics and implications to this. And I don't want to dismiss what landlords and, you know, as a person who lives in a family-owned home, owned by my family, and, you know, we have a renter, like I understand that plight. That doesn't actually negate the fact that majority of New Yorkers are actually facing the opposite. And that our mandate is really to decide, you know, like to make decisions on what we think is going to happen with the facts that we have in the moment. And so there were years we saw 8% increases on 2-year leases almost. We didn't think, oh, things might get worse for tenants that year. And I think that that's the whole idea of the sky falling with the rent freeze those 2 years in 2016 and 17. When we saw that data, we didn't see the impact that folks sort of thought would happen. And so I want to be cautious on like over projecting, because I want to recognize that, you know, we don't want tenants living in buildings that are falling apart. We don't want tenants living in foreclosed buildings. We work in buildings that were foreclosed before this. And it's a hard thing for tenants. And it's also a really hard thing to see, you know, landlords try to manage, because sometimes they made a bad business choice, buying more, purchasing more, maybe. And sometimes it's just like, they didn't manage buildings well. And that's like hard for, you know, us to sort of tell tenants, but we have to, because it's recognizing the reality that there is someone who is about to lose everything they put into, to make money, to invest. And that's like not good for anyone. But as well as the fact that we, for decades, has seen this board, you know, not look at tenants' perspective in a way that like has felt meaningful. And I think that we as a board, this iteration of this board has been really thoughtful in that, in the discussion we're having today. But that doesn't negate the fact that, you know, saying things might get better for tenants, you know, no one who was making minimum wage is going to be back working. McDonald's is not going to be hiring at the same rate they were before this. Like that's just real. That's just being real. Restaurants are not going to have enough and as many people, because we're talking about social distancing in restaurants now. You know, what does it look like to go to the movie theater if you work there, and how many employees they need then post this? I do feel like we're going to be in a post world that we don't know what it is, but I don't think that it should prevent us from acting now. And I think that that's like the major thing that I think for me is a takeaway. Like acting now means we protect people long term. And then maybe in 2 years, we're going to be like, oh, tenants are doing well. And then the board will decide on that basis. But I don't think we should make a decision on expecting things to get better for folks when it comes to tenants, but not saying the same thing. You know, tenants don't have a forbearance program for their rents. When this is over, there is no protection right now in place. The city, state, and federal government have not acted. And that's what we know right now. I don't want us to think about like, what if they do get some release in July? What does that actually mean for people who are now feeding their kids 3 meals when they were in fact only feeding them once? What does that impact mean now that you have to buy Wi-Fi and computers and, you know, think about taking care of your elderly folks if you're sick yourself? Like, it's just a lot of unknowns that I feel like we really have to come to terms with. And we're not in a place to make decisions other than the fact that unemployment is going up, other than the fact that people are asking to be fed, other than the fact that public assistance is increasing right now. I can tell you the calls that I get that are devastating. That's probably why I look the way I do. It's just, you know, everything is weighing on us in a different way when we're constantly talking to people about how to get snacks for their kids. That's just like not a good place to be in. And there's so many workers doing that right now, but there's so many families dealing with that and the weight of that. And I don't want us to say, well, you know, in 3 months, it could be better. People will not recover from this in 3 months when they were making $15 an hour before this. You just can't jump back.
I'm not trying to minimize at all what you or anyone else is going through, because we're all going through it to a certain extent. What I'm saying is, I don't think that we have to make a decision today for what is going to be a year or a year and a half from now. Right now, I can understand the position to say that it should be 0 for a year. I cannot understand nor support that you think it should be 0 for 2 years, because we don't know what's going to happen. And this is a 3-month period of time, and we meet again next year. And the tenants should take, if it's a 0 for 1 year, tenants should sign 1-year leases and not be able to sign a 2-year lease, so that if things are better, and hopefully they are better next year, then the owners get hit again for a second consecutive 0. So no, we don't know how many people McDonald's is going to rehire, and we don't know what's going to happen in the movie theaters or in the restaurants, but we don't know. And this is a 3-month period of time, which is horrible for everybody. And we have to sort of wait and see what the government's going to do, how they're going to help people, etc. But this is a board that is designed to figure out increases for a 1-year lease or a 2-year lease. And I don't think, because of a 3-month period of time, that it should be decided that no, on the second year that owner. I can't understand that, nor can I support that. I understand I'm only one vote, and obviously, I'm here to support the owners, but even as an individual, and I've been a rent stabilized tenant in the past, I know what it's like, but I just don't see where you have to jump to the 2-year period, because then it makes sense for almost every tenant to accept a 2-year lease, and it would be 0. So why wouldn't they take a 2-year lease? So what I'm saying is, I hear you. I understand you're asking for something, immediately, but I don't think you should be able to jump that on to the next year. That's my position.
Let me just interject with something. Andrew and I had a meeting with the law department earlier this week, and we've asked them to kind of advise us as to how much flexibility we have in setting the 2-year. And so we're just waiting to get advice about how broad our authority is to do anything, anything that anything differently with a 2-year lease. So we'll
That would
report
include
back.
a negative?
We've asked them to give us a sense of our legal authority. That's what we've asked them for. How broad is our authority, as opposed to just setting a number, for instance?
David, can I ask you a follow-up on that? Is there conversation about, I mean, we've had conversations in the many years I've been on the board, and I've stated it publicly many times, this board should be a year-round board. I feel like that statement I've said so many times, and no one has wanted to do it. But nevertheless, is there a scenario where we can vote for the 6-month period and then reconvene in 6 months to look at another period? I mean, I think we need a shorter economic cycle in order to really evaluate this stuff. I don't think, I hear both Shayla and Patty. I don't know how we can make a decision on the 2-year, but I think one should even question, how can we make a decision even on the 1-year?
My understanding, and Andrew, do you want to take that, or I can take the first stab at it?
As the law stands now, the board cannot reopen a guideline. So and we have to set a guideline for that period of October 1st through September 30th. There was a time then the board in the 70s, and I think it was maybe 1980 that was removed, where you could reopen the guideline and you could readjust, but they eliminated that option for the board. So currently, under the law, we can't reopen a guideline that's already been done, and it has to be for that 12-month period. That's my understanding. So that's what so that's the hand we're dealt.
Any other comments on the income and affordability study? And then I'll wait for a second for that, but I'll also just ask, do people want to take a 5-minute break before we hear the mortgage survey report? So it sounds like we want to have a 5-minute break, but let me first see if
Can I make a comment before we take our break?
Yeah, Shayla, go ahead.
Yeah, I was just thinking about, like, I think what this wave looks like, what this pandemic looks like for mostly people of color, poor people across this country, means we go back to work before everyone else. And I don't want to lose sight of that. This terrifies me. 31 states right now are reopening their economy, even when they haven't hit the peak of the pandemic. And the service industry that they're opening are the folks that tend to be the more marginalized. I'm hoping we don't make the same mistakes here in New York City, but I do feel like I think that it is a thing to consider, that the folks we are talking about are the folks that, you know, clean homes, that feed us, that, you know, are working at warehouses through this time. And you know, those are the folks that we are housed in rent stabilized housing, right? Based on the income, based on the rate dynamics, and based on the industries. And I want to make sure that, you know, as we have all these conversations about segmentation, that we don't lose actually sight of, you know, you stopping income for someone who makes $100,000 a year for 1 month, 2 months, or 3 months is different than you stopping income on someone who didn't work a week before that and has already been behind on their rent as a result. When the city was closing down and sort of work started to people started going to restaurants and things like that, we saw our members lose their hourly, you know, restaurant jobs right away. We saw hours reduced right away, and we're not even, you know, we're not even back at what those people will be working at in the future. And I think that, you know, when we think about those segmentations, I think we should think about who are we segmenting out, because they aren't, you know, the middle income Americans that we are segmenting out when we talk about rent stabilized housing. We are talking about the most marginalized, the browner, the, you know, blacker folks in our community who have been marginalized for generations. And I think it's a really big injustice that we're seeing this across the country. I think that as New York City, and I say this a lot because I really believe that we are a model. We are the folks that can lead the country in a way that's different. And I hope that we see our mandate and see the impact of our board in that way, because I think it is that important right now in this time.
Any other comments before we take a quick break?
Yeah, just to let people know that we're going to just mute you and turn your video off for the duration of the break, so that, you know, people don't see what you're doing and that they don't hear the noise in the background or whatever. So we'll do that on our end, and then when we start up the meeting, we'll obviously, you know, release those controls and let everyone join as they normally have. So how long do you want to take, David?
Should we say till 10:50? That's 6 minutes.
Sure, 10:50. Does that sound good? All right, great. Thank you.
All right, it's 10:50. Is everyone back?
I'm back.
Back. Everyone's moved around on my screen.
Switch places.
Patty, we were next door to each other. What happened? You moved away.
It's the next episode of Hollywood Squares.
Well, that would be more fun.
What was it? Paul Lynn was on that all the time.
Yes.
It was the only job he had.
I think those of us who are laughing about Hollywood Squares are dating ourselves, unfortunately. So
You're right.
I think you're probably right, David.
That's almost all of us.
Yeah, I saw it once on a comedy thing where they like showed a thing of what it looked like. That was like my only interaction with it.
Circle gets the square.
Circle gets the square, right?
There you go.
Is Brady Bunch older than that? Is that around the same time or like? 'Cause
I think around the same time.
Around the same time, I think Hollywood Squares went into the early 80s, I think, if I'm not mistaken. But and the
I'm
whole Brady Bunch thing is fun. But anyway.
not able to turn the video back on.
can we release it?
Host has stopped it.
Alex, let's see if we can figure it out on our end.
I'm back.
Okay. All right. Leah, can you hear us?
I can. Oh no. I am eating an apple now, so I didn't want to start my video. I'm sorry.
I
It's
totally
all right.
expect that.
Are we live right now?
Yes.
Oh Lord. All right.
Cecilia,
Everyone heard your apple comment.
Cecilia, can you hear us?
Hello?
Cecilia, we can't hear you.
Hello, can you hear me?
Now we can.
Hello?
Yes.
Okay.
We're good. We hear you, Cecilia.
Can you hear us?
Thank you. Yes, I can.
Great. Okay, Andrew, are we turning it over to Brian or?
We are turning it over to Brian.
Okay, good morning, everyone. Thanks for joining us today. I'm going to do the mortgage survey report presentation. You should see it on the screen now. Sorry. This report focuses on data from 2019 and the early part of 2020. Due to the as yet known full impact of the COVID-19 virus, it does not reflect the current condition of the New York City multifamily building lending market and should not be interpreted as such. Future editions of this study will better illustrate the impact of the pandemic and its economic ramifications. Since the 1980s, the RGB has been conducting the mortgage survey, which gives a sample view of the lending market faced by borrowers. The board is required by the rent stabilization law to consider the cost and availability of financing in its deliberations. In compliance with the law, each January, we send out surveys to financial institutions that underwrite mortgages for multifamily properties in the city. The survey covers 4 main areas: new and refinance loans, underwriting criteria, non-performing loans, and the characteristics of buildings and lenders' portfolios. Survey findings are collected in the mortgage survey report, which highlights changes during the prior year. The report is divided into three sections. First, we do the main mortgage survey analysis, which looks at all the respondents. We do a longitudinal analysis, which looks at only those lenders responding in both the current and prior year. And we, in addition to the survey, we also examine rent stabilized building sales data. Each winter, the survey is mailed to institutions that offer loans for multiple dwelling rent stabilized properties in the city. The survey is updated each year to include only those institutions that continue to offer new and refinance mortgages. We received 10 responses this year, down from 11. From the 21 surveys mailed, 48% participation rate this year. Before going into detail, here's a brief summary of our key findings. Interest rates charged on loans decreased. Upfront service fees, called points for mortgages, declined to a record low. Vacancy and collection losses also decreased to a record low. The maximum loan to value ratios rose, and in our analysis of building sales data, the number of stabilized buildings sold in 2019 declined. The average interest rate decreased this year. This year's average interest rate for multifamily mortgages declined to 3.99%, a decrease of 66 basis points or 14% from a year earlier, the second consecutive year it has declined. Now this graph, and all the graphs are also in the report, shows average interest rates charged for new mortgages over almost 4 decades. Interest rates were once much significantly higher, residing in the double digits throughout the 1980s, and then fell to the single digits in the 90s. And this year, the average interest rate, like I said, was 3.99%. The points, which are upfront service fees, fell to a record low this year. The average service fee charged on new loans by lenders was 0.22 points, a 16 basis point or 43% decrease from the prior year. Among the survey respondents, they ranged between 0 and 1, with 6 surveyed lenders charging no points on new loans. This graph shows the average points that were charged for new mortgages since the early 80s. After averaging between 1 and 3 points in the 80s and 90s, the average fees have been at or below 1 point for over 2 decades. And like I said, this year's fees charged by lenders fell to 0.22, which was the lowest level in the survey's history. This year, average volume of new mortgage originations in our survey rose to 127 loans, a 35% increase. In addition, the average number of refinance loans rose at a greater rate this year, almost doubling to 112 loans this year. This year's lenders adjusted some lending practices since last year. Among surveyed institutions, the typical maximum loan to value ratio, which is the maximum amount respondents were willing to lend based on a building's value, ranged from 60 to 82.5%. This year's average, 73%, was 1 percentage point higher than last year's 72%. The debt service coverage ratio, which is NOI divided by debt service, remained unchanged at 1.21. Now this graph illustrates lenders' standards for maximum loan to value ratios over the last 2.5 decades. Like I said, this year's loan to value ratio increased by 1 percentage point from last year to 73%. The survey asked lenders whether their lending standards differ for rent stabilized buildings versus non-stabilized multifamily properties. Respondents were asked whether their new financing rates, refinancing rates, loan to value ratios, and debt service coverage requirements for stabilized properties were higher, lower, or the same as for other properties. Most lenders reported no difference between stabilized and unregulated buildings. The number of lenders reporting that they had non-performing loans was the same this year as last year, with 2 lenders reporting that they had non-performing loans, and it represented less than 1% of each of their portfolios, the same as last year. And likewise, just 1 lender reported foreclosures this year, also the same as last year, and that represented less than 1% of that lender's portfolio. The size of buildings in surveyed lenders' portfolios varied widely this year. The average size of buildings in each of the 10 lenders' portfolios is evenly distributed among all building size groups. 2 lenders reported a typical building was 1 to 10 units. Another 2 reported a typical building was 20 to 49 units. Another 2 reported an average building of 50 to 99 units, and 2 additional lenders reported an average of 100 or more units in their typical building. This graph illustrates vacancy and collection losses since the mid-90s, with the most recent year at the top and 1996 at the bottom. And it shows that vacancy and collection losses have fallen each of the last 7 years to 2.17% this year, which is a record low. The survey also asks lenders about the performance of their portfolios compared with expectations at the time of initial loan origination regarding NOI, debt service coverage, and expenses. Most lenders reported that their expectations had been met or exceeded in all areas among rent stabilized properties in their portfolio. Specifically, 80% said that this year's expectations were equaled or exceeded among all three categories. That was similar to last year. And 70% of lenders reported that they keep their mortgages in their portfolio rather than selling them to secondary markets. That's about the same proportion as last year. Next, we'll move on to the longitudinal analysis, which examines findings among institutions that responded to our survey both this year as well as last year. Among our 10 respondents, 9 responded last year as well, and this makes up the longitudinal group. Like the main survey analysis, the longitudinal group saw interest rates fall. The most recent interest rates reported by lenders in the longitudinal group was 4.05%, down from 4.63% in the same group a year earlier. Among the longitudinal group, average points offered by lenders also declined from last year from 0.35 to 0.24 this year. The average maximum loan to value ratio rose among the longitudinal group, increasing from 72.5% to 72.8%. The debt service ratio declined slightly from 1.21 last year to 1.19 this year. And vacancy and collection losses among the longitudinal group declined, falling from 2.5% last year to 2.38% this year. Next, we'll move on to the analysis of stabilized building sales data. In 2019, 650 buildings containing rent stabilized units were sold in the city. That was a 27% decline from the prior year. Looking at sales data by building size, the change in sales varied greatly. Among the smallest sized rent stabilized buildings, among the smallest sized building size, sales fell 19%. Among 11 to 19 unit buildings, sales fell 8%. Among 20 to 99 unit buildings, sales volume declined 44%. And among the largest 100 plus unit buildings, the sales actually remained unchanged at 22 buildings sold in each of the last 2 years. Every borough saw sales volume decline. Sales fell the most in the Bronx, down 48%, followed by Brooklyn, down 22%, Manhattan, down 21%, and sales fell the least in Queens, down 17%. And just a note, as we mentioned in the report, that Staten Island sales are not included because there were too few rent stabilized buildings sold in the borough. After passage last June of the Housing Stability and Tenant Protection Act 2019 in June, we decided to take a look at the change in sales of buildings in the second half of 2019 and compare it to the same period in the prior year. In the second half of 2019, citywide sales fell 37% from the same period in 2018. By borough, they fell 58% in the Bronx. In Manhattan, they fell 42%. In Brooklyn, 28%. And in Queens, sales fell 8%. This graph shows building-wide sales, citywide since 2003 for the full calendar year. It shows that citywide sales were at their peak in 2005 in this period with 1,816 buildings sold, and at their lowest in 2009 when just 521 buildings were sold. Sales of buildings continued to rise until 2013, but it has declined in most years since then, including this past year when sales declined 27% to 650 buildings sold. Now we'll shift to an analysis of sales prices of buildings. The median citywide sales price was $4.2 million in 2019. The highest median sales price was in Manhattan at $9.6 million, followed by the Bronx, $4.5 million, Brooklyn, $2.4 million, and Queens, $2.1 million. Looking at sales prices by building size, the median price for a building sold that contained 6 to 10 units was $2 million. Among 11 to 19 unit buildings, median prices were $4.9 million. Buildings with 20 to 99 units sold for a median price of $9 million. And among the largest buildings, which contain 100 or more units, they sold for a median price of $36.6 million. So to sum up this year's mortgage survey report, average interest rates declined, and both service fees as well as vacancy and collection losses fell to their lowest level in the survey's history. In addition, the number of rent stabilized buildings sold declined from the prior year. And just a reminder, as I mentioned earlier, with all the reports, the data does not yet fully focus on what has been going on with the pandemic. And future reports will have a better sense of how that's affecting the multifamily building lending market. So thank you very much for your time. And if you have any questions, I can now answer them.
Brian, I had a question. The sales prices by unit size, when it was broken down by 0 to 10 units, is that 0 to 10 rent stabilized units in the overall building, or the overall building is 0 to 10 units and some of them?
Yeah, we only know it by building. So we know that if the building does contain rent stabilized units, it would be, and it was registered with the HCR, it would be included. So it's just the total, it's based on the total number of units, not just rent stabilized.
Okay, thank you.
I have a couple questions or comments. One, would it be possible to show the average price per unit or per square foot rather than show it by building, so you get a better sense of it in a more granular level? That's one question. Another is, I was struck that the data on mortgages, loans was going up while number of sales was going down. Is that because the mortgage data reflects refinances combined with purchase loans?
Well, we have refinancing loans separate in terms of the count.
So the building purchase numbers are going up, even though it's a subset, obviously, of all the lenders.
The number of loans went up, but it's just based on what the lenders in our survey reported. So we had a few large lenders, and a couple of them didn't say they weren't reducing their loan volume necessarily.
It's inconsistent. The other thing I was struck by is that this decrease in building sales seemed to have taken place as well before June as well as after. And I thought that would be interesting to maybe look at the sales volume through June and after June. I know you showed for the entire year and then the second half, but it'd be interesting to look at the first half of the year and the second half of the year.
Right. I'm sorry, sales were, except for, from 2018, they went up a bit, but generally they've been decreasing for several years. So I think
that's interesting to see, what the pattern is before and after the law change.
But Alex, you understand, people who were buying and selling buildings had a lot of insight through all of last year about the laws would not change in favor of landlords. And no matter which way they went, they went very extreme, but they would never favor landlords. Buyers knew that through all the purchases.
Anyway, just seeing the data, I think would be interesting.
I would say from my perspective, seeing the data sort of decline, to me is like a hopeful nod that maybe there's less speculation happening. We knew that there were owners coming in and buying buildings that 3 years ago were bought and they were 8 million, and now buying them for $10-15 million in the Bronx, where we know the rent rolls are a lot lower than other boroughs. And so we knew that they would be in a tricky, that there was going to be a lot of over leveraging if this continued. And so to me, it's good for me. It's hopeful that specifically in the Bronx, we're seeing potentially speculators buying less. Like normally we are like in a building and there's like 3 owners in a span of 2 years where it's getting flipped, and we're not seeing that as readily as we had in the past. And I don't know if that's like feels anecdotal, but if we have any data to sort of we're seeing the quality of life or the quality of buildings maintenance, you know, sort of increase, while we're also seeing like the sales decrease, which I think it's like at odds with each other. But to me, it's like a good indicator that maybe things are going to be better, and that owners who I think Patty and Scott tend to represent are the owners who want to be responsible, are being more responsible as we go through this process and as they go into purchasing more buildings, because we know that's not going to stop. Hopefully it won't stop because we need to have that move, but that it won't happen in order to speculate, because I think it does it hurts community, but it also hurts owners long term. You know, if we have another bust, which people had been predicting before the pandemic hit, on, you know, over leveraging in New York City, specifically multi units in across the city. And I think that like, if to me, it's like a good nod. I don't know if like there's data to support it, but what we're seeing on the ground seems like hopefully that means that people are being more conscious, are saying the RGB is not necessarily just increasing rents at, you know, at insane levels. You know, the state laws are dialing back. That means that, you know, our bottom line might have to be more conservative. And, you know, hopefully that means that they're moving with the economy, with what's happening on the ground in buildings that they own versus, you know, it being a bad thing long term.
I do have data for you, Alex, regarding your questions earlier. I do see that we did calculate in the first 6 months of the year, 2019, it did decline. Sales volume of buildings declined 15% from the prior year.
Thank you.
And sorry, and also I do have the price. I think there was a question about we can't calculate it based on square footage, but the median sales price of a building per unit actually went up slightly. The median of all buildings sold, the median sales price per unit is $398,000 in 2019. In 2018, it was $371,000.
We did share with the board a memo that took a look at unit count sales versus buildings that was sent to the board on Tuesday. I mean, we could share, Brian, do you have that up by any chance? We could share that graph, but we tracked the building sales versus unit sales and the graphing and how it, you know, from year to year. It was similar graph.
I don't have a final copy of the memo.
I could show it. I'll show it on my end.
Alex, while Andrew's doing that, could you, okay, go ahead, Andrew.
I'm sorry. Yeah, so we had done the number of units versus the number of buildings sold, which is in this table over here. And the average units per building sold. But if you look at the two graphs here, the top one is by building and the other is by unit count. So not surprisingly, I mean, there are some variations, but the two graphs.
Directionally right.
Yeah, but we can give you, you know, more granular data on the sales price per unit. We could include that as well for each year, Alex, and we can get that to you.
Andrew, is it possible before our deliberations end to ask the lenders who participated in the survey to advise the board on their different collection levels they're seeing within their loans? You know, March versus April versus May. I mean, we've heard in the publicly traded space, you know, these things. You know, some people have had 20% collections down already, and some people have reported, you know, things in the 60s and 70s already, you know, early in the cycle. And then also my follow-up question of that as well is if any of the lenders in the survey could provide some context on if a loan was up for refinance or someone was a new borrower, who, you know, had a 60% collection in their building, how would they underwrite that loan? I mean, it's obviously, we all hope this is temporary, but it's a complicated calculus to underwrite. So I just don't know if there's a way that any of those survey participants would potentially answer that question anonymously, so that we could have more context of how these different issues intersect with you know, stability in housing.
Yeah, we could go back to Scott and see. I don't know how quickly a response we would get. So in terms of deliberation, I don't know if we would be able to get any data prior to, say, our preliminary vote, but afterwards, if they're willing to comment. I know, you know, there may be some, yeah, you know, I guess they could, I don't know, we'll just have to ask them and see.
Yeah, I mean,
be willing to
yeah.
get that information. I just don't see it happening before.
Yeah, I've said,
preliminary vote,
yeah,
but it's
I've
something
said
that we
that
could,
if we can't get
maybe
it.
in May, that they would be considering what happened. They could tell us what happened in May and what's currently happening. Sure.
Yeah, I mean, they're going to be looking at their LTVs and if people are breaking their loan covenants. So they're going to have insight to this. It's questionable if they will, how comfortable they'll feel sharing it, but I completely sensitized to that you can't get it for a preliminary vote, but I think it should be part of our deliberations to just understand this lending, this similar to our first file. I don't know if this presentation had the COVID disclaimers on it, but this whole presentation deck, in addition to it's always been a little bit of a slim pickings, it declines every year, that people who respond, but this kind of immediate real-time feedback is helpful because the data is going to look greatly different when we meet next year.
Scott,
maybe David, you do this, so you probably have even more insights into this.
Scott, I was actually going to ask. You had referenced what you'd been seeing for publicly traded securities and equities. Do you think you could share some of that with us, and we could distribute that?
You know, I participated at a ULI panel where Rose Associates presented their collections for the year to date and divide out the months. I don't know if they would publicly provide that. That was, you know what I'm saying, but I'm just at that point, there was someone from a public company who their earnings hadn't been released, so they couldn't say, but the earnings reports for all of those residential REITs are right about now. So again, some of them will disclose New York, but a lot of times they will roll it up. But I will, if I come across it. But the collections in what institutional owners would call like the C class properties that are not new construction, that tend to be older, was definitely much more impacted. I think the example was if new construction A class building for April had something like 92% collections, the C was probably 10 to 20% lower. And just a lot of questions on how. I mean, some people are moving out too because they're deciding to live with their families or double up or do alternate things. So there's two things happening, right? There's the collections not coming in, but then there's also units, at least in the market rate sector, that are definitely not getting refilled. So.
Mm-hmm. And Alex, can I follow up on a question that you had asked Brian as well? You had said that you thought maybe there's an inconsistency with the data. Can we just play that out just so we understand if we need to make any tweaks? We can't hear you, Alex.
Just noting that while the sales of buildings are going down, the number in the sample of lenders, the number of building purchase loans has gone up.
Brian, could you pull up those slides again so we could take a look at that?
But it's a sample. It's not representative.
Sure.
Yeah.
I think too, Alex, I think that would point a little bit to somebody maybe necessarily wouldn't take out a loan always at their initial purchase. I mean, most people would, but maybe that creates a little bit of difference in your sample.
This is the number of loans per institution. I don't have a slide with both on the slide with both of them simultaneously.
But now Alex is comparing this, and I don't want to put words in Alex's mouth, but he's comparing this to the number of sales. So it's 127 times 10 times 11 institutions. So that's like 1,400 loans for new loans. But then the total number of sales was how much for the year? So it's odd. It's an odd thing that they may be labeling new loans. Maybe it includes if you're refinancing from another lender. Brian, is that possible? Because we know the total universe of sales has to be 650. It can't be.
That's the average. But doesn't mean, I mean, some lenders had very few loans, but yeah.
And Brian, that may just be something worth looking at, because that I think Alex is right that just seems odd.
Right, the lender with the largest number of loans, I did check with them, and they said that was the accurate count for rent stabilized buildings. So I can't say why there's a difference.
Oh, wait. So the first slide is all loans, not just all rent stabilized loans.
No, it's supposed to be rent stabilized loans.
Oh, that's odd.
Also, if you could look at instead of looking at just the average, just look at the total number of loans across across the 10 lenders.
Right.
See if the number would be different.
Yeah.
All right, well, Alex, we'll follow up on that.
Okay, yeah, it's not a big deal. I was just struck by that. But I do think that having the sales price per unit would be valuable, and if it could be done by borough, because as you pointed out last week, that in the outer boroughs, the percentage of rent stabilized units within a given building is much higher.
Yeah, no, Alex, we could definitely do that. Just to reiterate that, the survey is filled out by lenders. That's what they tell us.
Mm-hmm.
We'll fact check some of it. If we see some inconsistencies, we'll call them back. But they are under the understanding that it's for, stabilized loan. It may be somewhat of the timing of the loan versus the building sale registered with finance. So there could be some, timing as well, where a loan's approved with the sale. I'm not sure if the sale goes through or not yet. So that could have something to do with it as well.
Okay.
Andrew, I received a question from a tenant, and they want to know, in the 2015 PIOC report, it refers to owners of rent stabilized buildings, and the reports currently refer to owners of buildings that contain rent stabilized apartments. I'm pretty sure I know the answer, but they wanted to hear from you about the new language and what that means.
Yeah, we simply changed the language this year. We'd always call the building rent stabilized. I guess that's a bit deceiving. It's buildings that contain rent stabilized units, because there's units that have both market rate units. And so to define it as a rent stabilized building versus a rent stabilized building that contains rent stabilized unit, it was a more accurate way to define the type of building. It doesn't change any of the numbers in any way. It doesn't change how we did the report. It just clarifies the definition. That's the only reason why we did it. But somebody out there is reading our reports. I'm very happy about that.
Yes, they do. They actually, I received multiple emails yesterday about why they wanted today's reports now. So there are actually a lot of fans of reading the reports.
Well, I appreciate that, and we try to get it out as quickly as we can. This year has been particularly tough with all the changing dynamics. So in some way, I'm apologizing to those folks who we can't get it out there sooner, but we're trying to be as accurate and with the most current data. And so we appreciate you saying that, Lee. I do, and I wish I could give a week with the report, but it never seems to be able to be done that way. So.
Yeah, no, I want to thank you and the staff, Brian and Danielle. Thank you to all of you, just because I know personally how difficult it has been for me to sometimes just sort of get up and be in the mind frame of doing work, but to do a report, it's a lot. So I want to thank you for all the work that you all are doing, especially in light of how difficult it is just to process everything that's going on and then produce something that's helpful to millions of New Yorkers. So thank you.
Thank you.
And that many people are reviewing, by the way. So it's not, you know, a lot of people are definitely looking at it. They email Shayla and I questions. They nitpick and what this figure means. They're comparing it from 5 years ago. So a lot of people do review your work. So thank you.
Thank you.
Thanks.
More comments or questions about the mortgage survey report? Okay. Should we move on to kind of board discussion? I think Andrew wants to kind of update the board. There was requests for more information about hearing technology. So I'm going to turn it to Andrew to return to that topic.
Yeah, so obviously we heard what board members said about availability for tenants to comment and owners to comment, or the public in general to comment. So we understand that, and we're being very sensitive to that. So we reviewed different ways that different government agencies were doing their hearings. Predominantly, they're doing them on Zoom, so that's a good thing. So we use Zoom, which is helpful. What we looked at and what we want to do, and after watching all these things, there were probably 3 or 4 important things that we want to do. One is that we want to have real-time testimony. So we're going to figure out a platform that we can do it the best way going forward. We want to also have the ability for people to participate by submitting written testimony, certainly. And I believe that we could do a way that they could submit also video testimony as well. So we want to make sure that is there. And we also do obviously want a way that we can provide interpretation, both with what's handed in with written testimony and to the extent of what we have, obviously, when we have our live streaming testimony. So those are the 3 things that we want to ensure that we can do. So we're looking at different platforms, and at the same time, we understand that we want to have a fair and balanced way of having people who come to testify have that opportunity to do so. So we are taking in all those considerations. So we just wanted to put it out there to let you know that we are looking at it. You know, our requirements are that we have to have at least 1 public hearing, and that we also need a 30-day comment period between the time a public notice for comment is put in the city record to the time of our first hearing. And those, so those are our legal requirements to do that. So I just wanted to throw that out there. So we were on top of all those type of things, and those are our concerns. And we've looked at, and we continually talk about the best way of doing those. And so if there's other comments you want to make on that, that's fine. We would, you know, there's still feedback of what we want. But those are things that we will include no matter how we do this. And I don't know, David, if you want to add anything to that, but that's where we are with the process.
Yeah, I don't have much to add other than the staff and I have been kind of looking at the hearings of other government agencies, and I think I'm just going to say nobody has it perfectly, but everyone has its strengths and weaknesses. So I think the staff is trying to think of what can we take from one format and what can we take from another format and kind of make it work best for us. So that's kind of what they're trying to do.
Similar to like people taking video, will there be a way for people to audio, sort of similar to leaving a voicemail where they could just call? Because that sort of a landline phone technology might be more accessible to some than doing a 30-second or however long sort of selfie video.
Sure, and yeah, and to that extent, we would, because obviously we're realizing not everyone has the capability to do a video or the ability to upload the video even if they film it. So yes, we would have a place as well to do audio. And then obviously we have to figure out the best way for it to be distributed to the members of the board so they can to listen to it and view it as well and read it. And again, to that, that's a good point. I'm glad you brought that up. Is that, you know, whatever the live testimony would have, people would be able to participate over the phone as well. It wouldn't be something that they would have to participate through Zoom, that they could participate with video on your computer, but participate through Zoom using their telephone as well. So we want to make sure that that's available to everybody, and that we understand that. So yeah, so we're all the different platforms, and ultimately, if we have a registration period to come on, which is most likely the situation, is that people could register by even calling our office, by emailing us. So the regular avenues of registration would be available as well. So I think I've said what I was going to say.
Question about interpretation. I know that the interpreters that we've normally used for hearings are still working through Zoom. And I know that your account has to be upgraded for that interpretation to happen really seamlessly, where you just select the language so that we're hearing the language. And well, if you speak Spanish, you can listen to it in the native language that they're speaking, or if you don't, you can listen to it in English. But is that something that you guys are looking into?
Yeah, and if you can if there's any way you can give us examples of that, we have the webinar through Zoom. So, excuse me, to add on anything that we need to make something like that happen would be great. We haven't seen an example of that yet honestly, with any public testimony. If anyone out there has, that's one function that we have not seen is interpretation. So if anyone has that,
well, I haven't seen
willing to share it and walk us through the process, that would be great.
I haven't seen it in public hearings, but I know that we are doing it.
In personal meeting.
Yeah, and so we held a meeting last night, and it was live streamed on YouTube, Facebook, and people were on Zoom and could call in also, and that happened all in multiple languages other than English and Spanish. And I think that there is a world where we can try to figure that piece out so that it happens the way it happens at hearings. And Caracol, who we've normally used, they are the ones providing that support. And so they know, like if you tell them what you want to do, they sort of tell you the best way to do that with the tech they have or the tech that we have, that you have.
Yeah, I mean, ultimately, if we could have simultaneous, where people can press a button and say, I want to listen in Spanish versus English, that'd be great, because that would provide more time for speakers, which is a big concern too, because no matter what we have, I believe we're limited to the number, certainly, of hearings that we have right now. We have to have one. So the most time we can allow for people to actually speak is really important to, I think, all the members of the board and us as a staff. So if there's a way to have simultaneous stuff going on, that'd be wonderful.
Shayla,
there's potential. I was just going to say that there is potential that the testimony piece could go faster than normal because there is an opportunity for simultaneous during the hearings, specifically through Zoom. Yeah, I can. If it's helpful, I can help coordinate with like the interpreter, since we've been having so many meetings this way. Yeah, and we've had some hiccups, and hopefully I can share those learnings so they don't happen here.
Yeah, maybe Shayla, when we can just talk over the next couple of days, and we'll figure out maybe sometime. That'd be great. Thank you.
Other comments on this topic or questions?
I guess I have a question. How many hours do we have for the hearing? Is it 4 hours?
Andrew, did we specify that, or is that something that the board could put input into, or?
Yeah. But my question, I guess the question is, what happens if there are too many people who can, given, let's say, 2 or 3 minutes per speaker to accommodate, to be accommodated during that 4-hour period? Are there contingencies? Additional hearings, extending the length of it, cutting off I don't think we should cut off the number of speakers, but that is obviously an option if it's first come, first served. But I think we need to be prepared if there's a lot of people that want to talk.
I think
We've
right
gone
now,
late. We've always
you only have
whatever it
3
took.
hours scheduled.
So maybe I'll check in offline with people about what they think is the right approach, and then we'll come up with a proposal the next time Andrew and I will kind of propose something based on the feedback I get from people. Does that make sense?
Yeah, I mean, I think our longstanding method has been, as long as people sign up before the time ends, we have stayed 2 hours, 3 hours. I mean, if there's so many signups that it would potentially be, a day, 8 hours, then I think we're at a different fork in the road. But I think our longstanding practice has worked to make sure people could speak.
Yeah, I just think the big difference is that you have 8.5 million people who potentially could participate from home, and it's conceivable you could have 12 hours worth of speakers going into the middle of the night. So I think we want to set expectations appropriately, but there's probably a limit to what we are willing and able to do in one sitting, is my guess. So let Andrew, let me call around to people and talk about it with Andrew, and then we'll make a proposal next week.
We're pretty resilient, David. Don't underestimate us.
Scott, I'm willing to stay as long as you are.
I don't know if 12
I've never
hours
left
is
early.
realistic. You're gonna
4 a.m. 4 a.m. is my cutoff.
4 a.m.
I think
4 a.m.
Christina and
4 a.m. If
Christian
it
are
goes
gonna
past
go
4
running.
a.m., I want to take a break and go into the next day.
Okay, so Andrew and I will work on that proposal, but Scott has set a high bar for this original.
Jeez.
Right.
Scott, Andrew, anything else on your end, or?
Sorry.
Leah, yes.
No, that's not me. Sorry.
Okay.
I'm trying to
no,
stop a pet fight.
I think I'm done, David. I don't know if there's anything else. We have speakers lined up, I believe, from both tenant and owner members for next week. So it will be a very similar format to let everyone know that, those who were invited will be entered in to Zoom, and they'll have their opportunity to speak before the members of the board. So we have a session in the morning, and we've given board members a break, an hour break in the middle, at least. And so that is the plan. We will send out all that information. I have to send out a meeting notice this afternoon. I'll email the people I've been emailing. Feel free to spread those emails to whomever you think would want to participate in the meeting. So that's what's on the agenda for next week.
And for our new members, I would just say, in general, there's usually a very healthy exchange with the outside speakers who come. So you should, it's a little artificial with Zoom, but they're there really to answer our questions and help you make a good decision. So you should treat them as a resource accordingly.
I had a question about the conflict of interest stuff. Or is that stuff going to get mailed to us? That thing that you put in our envelope that we have to figure out how to get out?
I haven't heard a follow-up since they told me that it's been pushed back.
Okay.
I want to say the date off the top of my head was June 15th. So, but I don't know for certain when that's going to happen and whether we're going to be responsible for picking up the packets and distributing. I don't think they figured that all out yet. I think they're pushing it off to see where we are by the end of May and where we are differently with people going to work and doing all those kind of things. So I will keep you up to date on that. I know that you're anxiously waiting to complete the financial disclosure filings, but
I just get anxious that I'm going to miss the dedeadline.
Yeah, no, there is no deadline. You aren't going to miss anything. So there are no fines pending. Ironically, I think it was today initially. I think it was May 7th. I think it's our preliminary vote that they were initially due. I think maybe May 8th. It's usually a Friday. So I want to say it was May 8th was their initial one, but that's obviously not happening.
For the new board members, this is one of the highlights of your serving the good citizens of New York. The first time is rough. It's easy after the first time.
Yes, you
Yeah, it
probably
is.
want to have completed your tax return before you actually complete this form. So, any new business from members? Okay. All right. So
I don't know if,
yeah,
oh, sorry,
go
Dave.
ahead-
I don't
go
know
ahead,
if it's new
Shayla.
business, but I just wanted to recognize that I know that a lot of us in this world are, dealing with a lot. And I wanted to thank everyone for, making time in our brains and our lives to sort of handle and tackle this big mission that, often we're at odds with, but, I think that we're doing the best we can. And I hope that, as we move through this, we continue to have the conversations we're having, the push and pull, I think is important. And I hope we continue to do that, because I really do appreciate us being more intentional in this time to have these conversations. And as we move forward, and hopefully we can do the best we can in the fact that we have to keep moving sort of forward through this process. So thank you, everyone. I know it's a lot to share our homes, which we are. And on top of that, our ideas and thoughts while we're all grieving and, dealing with a lot. So thank you.
Yeah, I definitely want to second that. I mean, it's so first of all, thank you to all of my fellow board members and also to all the staff. I mean, it's for all the work that you put into this. This is, I mean, it's really a testament to public service. So this is great. And in particular, it's been really great to be able to have a staff that is pulling together all of these economic indicators for us. I mean, it's so that we can make an informed decision. I mean, so that's something that, I mean, to second what Leah had said earlier, I mean, it's a wonderful service. And I mean, it's especially during this time to do this. So thank you again, also to the staff for pulling this together. I think we can make a much more informed decision, and this discussion, I mean, is much more informed because of it.
Yeah, everyone stole my thunder because, behind the scenes, Danielle and Brian and Andrew have really been working very late on the weekends, turning around multiple drafts. So all of the compliments to them are definitely well-deserved. But I'll also just say, and this is echoing what Sheila said as well, I'm really proud to be on this board. I'm really proud to be the chair of this board. I think that the quality of the conversation we're having is incredibly thoughtful and informed by fact. And I think we're doing New York a service by serving on this board. So thank you all.
And just to add to that, I've been remiss in getting you our per diem form out to folks. So when you keep track of the hours that you're participating in the meeting, as well as outside the meeting, reading reports and talking to whomever, to each other, or to, the consistency, that you serve. I will get something to you. We wanted to really update it where it's something that can be done electronically, that you don't have to print it out to keep track of those hours. So so those per diem forms will come shortly. So
okay, I don't want to.
And thank you again for all the comments. It's always really, really nice to hear, and I think it's just always a morale boost when you get those kind of things. So I appreciate it, and I'm sure the rest of the staff do too. But thank you, and not to minimize Charmaine, who also has been answering a lot of phone calls and answering.
That's what I wanted to ask. I was like, "Where's Charmaine? It'd be nice to see her. Could she make a cameo in one of our meetings?"
Can we put her?
I do miss Charmaine.
Yeah,
Yes.
Can we put her up? I don't know how she joined. Let's see.
I just want to recognize that Charmaine is, I get calls from tenants saying I couldn't answer the question from you, get you to answer the question. I called the RGB and they were able to answer it. And I cannot stress enough how amazing she is on that phone, making people really feel heard, even though she, is sort of managing all
There
of that.
she is.
Charmaine.
Thanks, Charmaine.
Hi, Charmaine. Oh, you're on
Hello.
mute.
We gotta unmute her.
I'm trying, it's not working.
Oh.
Oh no.
Oh,
Yeah.
She's on. She's
unmuted
on.
now.
Can you hear me now?
Yep.
Yes.
Charmaine.
Hey, Charmaine.
Hi everyone. I'm listening.
Hi, Charmaine.
So,
Your name, address, phone number, and birth date are all pieces of personal information.
So I think that's a good sign to end the meeting. So let me not screw this up and ask for a motion to adjourn.
I so move.
Do I hear a second?
Second.
Okay. We are adjourned. Thank you. See you all on Tuesday.
Okay.
Thank you. Bye-bye.
Bye.